From your perspective, is right now the right time to finance an investment? And if so, what does the current financing landscape look like from your perspective?
I do think it's a good time for those investors out there to continue on with their strategies, and this is why. Right now, we're in a bit of a softer housing market, right? And we have more leverage as a buyer to go out and negotiate on these transactions, right? And when you have this negotiating power, you can implement different strategies on seller credits to help pay for closing cost or improve the terms of your loan that you won't have when it's a seller's market. I'll give you an example. Let's say you wanted to buy a $500,000 home today, and you want to go in and negotiate maybe 10% off that sales price, bringing it to $450,000. Right? Rather than taking all your leverage as a buyer and going in and negotiating off the price, I would say go in at this time and negotiate maybe 5% off the price, bringing it to $475,000, and asking that seller for a 5% seller credit. And then using that seller credit to pay for your closing costs, keeping money in your pocket at the close of escrow, and then using some of those seller credits to, again, structure your loan in a way that's going to meet your immediate goals of financing and maybe even long-term goals of financing. That's why it's a good time to invest right now. You as a buyer have more leverage than you did 6, 12, 18, 24 months ago. Now, I would say that window is closing, right? So if you want, now is a good time to buy. That window of leverage is closing. If you look at some of the data points that are precursors to where this market's going, we saw about a 28% jump in mortgage applications last week. Okay, so what that is the momentum building right now for buyers to go out into the market and purchase homes, right? More demand is going to create more of a seller's market. On top of that, inventory is not expected to grow substantially this year. We have a bit of a phenomenon where a lot of the people that own these homes are sitting on 3, maybe 4% interest rates, maybe even lesser than 3, and they don't want to break those terms and go out today and end up with a 6% interest rate on that primary residence. So they're not going to be sellers. Move up buyers in this market are going to be depleted, which is going to affect inventory, which I think is good for all of us because that will help protect housing prices from sliding too much. But again, if that inventory is low and we see an increase in buyer demand, you're going to lose your leverage as a buyer. So I think that window for buying might be 90 to 180 days, about 3 to 6 months, where we're still seeing pricing concessions being given by the sellers of the home, negotiating off of sales prices, listing times being longer on market. As far as the financing landscape, I think I thought about this question a little bit, and if we were to look at the mortgage industry as a stock, I think we have hit the bottom, right? And we're starting to climb our way out on these financing programs rates. I'll explain why. If we in fact hit this soft landing that the Fed's talking about, and we see the base rates on the Fed side come down a little bit, that's going to impact rates obviously to the consumer. But the other end of that piece, which isn't really talked about a lot, are the credit spreads. Not everything's going to be tied to that Fed rate, right? The price of your loan or your rate also takes into consideration credit spreads, things like your FICO score, the loan to value on the subject property. What type of subject property is it? So in a market like this where there's a lot of volatility, those credit spreads tighten. You see loan to values drop. You see FICO requirements increase, reserve requirements increase. So if we continue to hit this soft landing, we see some stability in the economy. Investors that are buying these loans on the secondary market are going to open up those credit spreads. They're going to increase the LTVs. The cost of that loan from a credit perspective will decrease. So I think from that perspective, an opening of guidelines, a softening of the credit spreads in the Fed, I think we're looking at a good trajectory for the financing.